Welcome to This Explainer. Okay, picture this. You're deep in the home buying process. You've done the standard math on the monthly mortgage payment, you've factored in property taxes, and you've got a pretty solid estimate for insurance. You're feeling great. You're ready to apply for that loan, and you can literally almost feel those shiny new keys in your hand. But right before you cross the finish line, you hit a hidden roadblock. It's this pesky little line item called the HOA fee. Just sitting right there on the listing, giving your financial future a rather judgmental side eye. So today, we are going to break down exactly why that little fee has such a massive impact on your home buying power. Let's get into it. Here's our quick roadmap for today. We're going to start with the hidden home buying cost, then we'll unpack the golden rule of DTI. After that, we'll explore why HOAs are monthly debt, uncover some underwriting red flags, and finally, look at budgeting for the permanent guest. All right, Section 1, the hidden home buying cost, squeezing your mortgage dreams. You know, it's incredibly common to get all your finances in perfect order, save up that massive down payment, and feel 100% ready to buy. But I want you to stop and ask yourself something. Does a community tax, this totally non-negotiable monthly fee, actually affect whether the bank gives you money in the first place? And beyond that, does it actually change how much money they're willing to lend you? Well, the answer is an emphatic, absolute yes. This isn't just some minor detail you can brush past, folks. This fee has massive, massive power over the bank's final decision. Honestly, it can be the literal difference between getting the green light for your dream home or getting a really frustrating rejection letter. Moving on to Section 2, the golden rule, DTI, also known as the lender's ultimate metric. So when you sit down with a bank, the conversation is pretty much going to center entirely around your debt-to-income ratio, or DTI. Mortgage lenders absolutely live and die by this specific acronym. It's basically a straightforward formula they use to figure out if you can handle those monthly payments. They take your gross monthly income and they weigh it against your total monthly debt payments. It is the absolute ultimate metric of your financial bandwidth. So here's the kicker. Lenders want your DTI to stay under a very specific, strict threshold. Generally speaking, they're looking for a ratio of somewhere between 43 to 50%. Now, the exact number depends on a few things, like whether you're applying for an FHA loan or a conventional loan, and of course, your credit score. But listen, if your total debt obligations push you over that magic percentage of your income, well, the lender system essentially shuts down your approval, just like that. Which brings us to Section 3. HOAs are monthly debt, the core mechanism. I want you to consider this direct comparison. Think about a $400 monthly HOA fee versus a $400 monthly car payment. Now, to you, one might pay for a nice community pool and some landscaping, while the other literally gets you to work every day. But to a mortgage lender, they treat your mandatory community fee exactly the same as that car payment. They treat it exactly the same as a credit card minimum or a pesky student loan. It is a mandatory monthly obligation that you absolutely must pay to live in that home. No way around it. And because it's officially classified as a mandatory debt, that HOA fee directly increases the total monthly debt payments part of your DTI formula. It pushes your DTI ratio higher. And if that extra monthly fee pushes your ratio past the bank's strict limit, you could outright be denied the loan. Or maybe even worse, the bank might force you to reduce the principal amount you're borrowing, which essentially slashes your borrowing limit right when you thought you were ready to go. All right, let's look at Section 4, underwriting red flags, evaluating the community. You see, the bank's investigation doesn't just stop at your personal budget. As part of the whole loan process, the underwriter was going to pull the HOA's financial documents too. They review the budget, the balance sheet, the meeting minutes, the whole shebang. They're aggressively looking for red flags, things like mandatory special assessments, overall signs of poor fiscal health, maybe super low reserve funds for future repairs, or even ongoing litigation involving the community. Bottom line, a poorly managed HOA makes the bank sweat. Actually, one of the biggest fears for a lender is seeing a massive, mandatory special assessment on the horizon for that HOA. If a big assessment is currently due or coming up fast, the lender may actually force you to prove you have the liquid cash in the bank to pay it before they'll even clear you for closing. They absolutely do not want a borrower entering a new home already saddled with a 5-figure bill. You can't start your homeownership journey in a financial hole, right? They just won't allow it. And that brings us to our final part, Section 5, budgeting for the permanent guest, the resolution. Let's look at a pretty critical contrast here. Say you're pre-approved for a $300,000 loan. In one scenario, you look at a property with a $150 monthly HOA fee. In the other, you completely fall in love with a community that carries a whopping $600 monthly HOA fee. Choosing that more expensive community effectively cuts your maximum affordable principal quite a bit. Because the lender has to account for that extra $450 in your monthly debt, the harsh reality is, with the higher HOA, you can afford a lot less house. So, when you're calculating your home budget, you really cannot just look at the list price. You have to treat the HOA fee as this kind of stubborn character, literally a permanent house guest in your DTI calculation. From day one of your home search, that fee absolutely must be factored into your total mortgage payment expectations. Which leaves us with this final important question to think about. How will you adjust your home search parameters now that you know the true cost of an HOA? The next time you're scrolling through those real estate listings late at night, don't just look at the bedrooms, the bathrooms, and the asking price. Make sure you look for that community fee and remember exactly how your lender is going to view it. Thanks so much for joining me on this explainer, and hey, happy house hunting!